1. The mechanical setup and inevitable loss. I want you to think about this exact scenario. You are sitting at your trading desk, staring intently at your screens. You've done your top-down analysis, you've drawn your key levels beautifully, and you are waiting patiently for price to arrive. And there it is. A perfect textbook setup forms right in front of your eyes. You execute the trade flawlessly according to your plan, and you place your protective stop loss right where the textbooks told you to hide it. And then, almost instantly, the market violently spikes against you, triggers your stop loss to the exact micropenny, and immediately reverses, rocketing hundreds of pips in the exact direction you originally predicted. You are left staring at a red loss on your screen, completely paralyzed by frustration, wondering if the market is personally rigged against you. It is an incredibly isolating and painful experience, and honestly, it happens to almost every single retail trader who enters the market. That profound frustration is exactly why we are doing this deep dive today. We have gathered a massive stack of highly advanced professional trading floor guides and institutional risk playbooks from the 2026 financial landscape. Our singular focus today is the brutal, high volatility market of gold, or xauusd. And our mission is to completely dismantle the traditional, outdated way you've been taught to manage risk. We are going to move entirely away from treating a stop loss as just an arbitrary safety net, and instead, we are going to expose how institutional algorithms look at your stop loss as a prime target, quite literally as high probability bait to engineer liquidity for their own massive block orders. By the end of this session, you will learn to read the hidden layout of order flow, stop being the exit liquidity for major banks, and learn to place your defense behind the institutional firewall. 2. Redefining the order book: supply, demand, and slippage. To fundamentally change how you trade gold, we have to start by completely redefining what you are actually looking at when you open the order book. Most beginners think the market is just a random number generator that reacts to shapes or trend lines on a chart. But mechanically, the market is a highly sophisticated matching engine that operates on the strict physics of supply and demand. Every single transaction requires a matching buyer and a matching seller. If you want to buy one lot of gold at a specific price, there must be a counterparty willing to sell one lot of gold to you at that exact price. Now, this order matching process is seamless for a retail trader because your position size is microscopic. You click buy and you are filled instantly because there is plenty of retail volume floating around. But large institutional players like central banks, sovereign wealth funds, or multi-billion-dollar hedge funds, they operate on a completely different scale. They don't trade in lots, they trade in massive blocks of capital. If a major bank wants to accumulate a $500 million long position in gold, they cannot simply click market buy at the current price. Why can't they? Because if they hit market buy with that kind of size, their own massive demand would instantly consume every single resting sell limit order at the current price, then every order a pip higher, then 5 pips higher, then 50 pips higher, aggressively sweeping through the entire order book. This violent sweeping of price against their own order is called slippage, and it would give the bank a terrible average entry price, completely ruining the profitability of their trade. They would literally price themselves out of a good deal. 3. Engineering liquidity: stop losses as resting market orders. Therefore, to execute a massive block order without destroying their own entry price, institutions require immense, highly concentrated pools of opposing orders. If they want to buy $500 million worth of gold, they must find an area on the chart where other participants are practically begging to sell $500 million worth of gold at a premium discount. And where do they find this dense, highly predictable concentration of sell orders? They find them precisely where the retail textbooks tell you to hide your stop losses. We have to look at the mechanical reality of what a stop loss actually is in the order book. Retail traders think of a stop loss as a protective shield, but to the exchange matching engine, a protective stop loss on a long position is technically a resting sell market order. It is a dormant order sitting in the ledger, waiting to be triggered. If millions of retail traders look at an obvious, highly visible support level, and they all place their buy orders there, they are all predictably placing their protective sell stops just a few pips below that support line. To an institutional algorithm, that area below support is not a danger zone. It is a gold mine of massive sell-side liquidity. The institutions know the exact psychological patterns of retail traders, and they know exactly where those stops are clustered. So, to fill their massive buy orders without causing slippage, the institutions will deliberately use their capital to push the price down, driving it right through that obvious level of support. The exact millisecond the price crosses that line, the institutional trap is sprung. A cascading avalanche of retail stop losses is triggered simultaneously. Millions of dollars worth of automatic sell market orders hit the exchange all at once, as retail traders are forcibly liquidated from their positions. And the institutions are sitting right there at that exact lower price level with their massive buy limit orders, happily absorbing every single one of those panic sales. They are engineering liquidity. They are using your forced sales to fill their own massive buy blocks at a steep discount before reversing the market violently upward. 4. Footprints in the chaos, order blocks, and fair value gaps. Now, moving hundreds of millions of dollars through a liquid market like gold requires immense effort, and that effort leaves undeniable, unerasable footprints on your chart. You stop looking at the shapes, and you start tracking these footprints. The first major signature of institutional participation is the order block, or OB. Mechanically, an order block is the final candle of the opposite direction before a massive, aggressive institutional displacement that breaks market structure. If the institutions want to launch a massive upward trend, they will first aggressively sell to sweep retail liquidity. That final down candle that gathered the stops before the explosive rocket upward is your bullish order block. It is the permanent physical footprint of where their heaviest buy orders were filled. The second critical footprint left behind by this institutional violence is the fair value gap, or FVG. When an institution injects an immense amount of capital into gold, the price moves so fast and so violently in one direction that it literally tears a hole in the price action. It creates an extreme imbalance in the order flow ledger. Mechanically, an FVG is defined by a three-candle sequence where the price moves upward so rapidly that the wick of the first candle and the wick of the third candle do not touch, leaving an empty space where only the second candle exploded through. This space is a vacuum of unacceptably unfair value. Because the market naturally functions as an auction mechanism seeking continuous efficiency, it will eventually treat these higher time frame FVGs as massive financial magnets, pulling the price back down to rebalance the order book and mitigate their positions before initiating the next real leg of the trend. 5. The gold specifics, extreme volatility, and inducement. Extreme, we must analyze the specific nature of xauusd to understand why these traps are so lethal. Gold is a highly volatile, highly leveraged asset that regularly experiences massive daily ranges of $150 to $200 from high to low. Because of this extreme volatility, gold algorithms love to execute a predatory behavior called inducement. Inducement is when the algorithm deliberately manufactures an obvious chart pattern, like a clean double top or a beautiful trend line, support specifically to induce retail traders into entering early positions and placing their stop losses right beyond the pattern boundaries. Once the inducement has accumulated enough retail capital into the order book, the algorithm executes a rapid, violent liquidity sweep. During high-impact macroeconomic news events, like the Federal Reserve interest rate decisions, CPI inflation prints, or non-farm payrolls, the volatility in gold accelerates exponentially. The HFT bots will trigger thousands of orders in microseconds, pushing price aggressively past the visible levels to sweep the resting stops. This is why trading a breakout or a pattern, the exact moment it forms, is financial suicide in the gold market. The initial breakout candle is almost always a lie. It is a manufactured exhaustion event designed to trap late buyers and sellers into becoming exit liquidity for the real institutional move. 6. Clinical execution. The 4-step deflation sequence. To survive this hyper-predatory environment, professional traders entirely abandon pattern prediction and transition to clinical execution. You follow a strict, mandatory 4-step sequence before risking a single dollar. Context: you only identify trading setups when the price has arrived at a higher time frame key structural level, like a 4-hour or a daily order block. You ignore the noise in the middle of nowhere. The sweep: you sit entirely on your hands and watch the liquidity sweep happen from the sidelines. You actively wait for the trap to spring on everyone else first. You look for that long, aggressive wick to pierce through the level and grab the retail stop losses, the shift. Once the sweep is finished, you drop down to a lower time frame, like the 5-minute or 1-minute chart, and you look for a microstructural change of character, moving aggressively in the opposite direction. This displacement is your concrete proof that the institutions have actually reversed the flow and are now driving price. Inefficiency: you do not chase that green displacement candle. You wait patiently for the price to pull back, retracing directly into the fair value gap or the premium discount zone created by that shift. This FVG becomes your highly protected entry zone. 7. Conclusion: risk management behind the firewall. By executing this exact 4-step sequence, your stop-loss placement is no longer a guess based on a static pip count or a gut feeling. Your stop-loss goes safely and logically beyond the absolute extreme low of that original sweep wick. Think about the mechanical defense this provides. If a major global institution just expended hundreds of millions of dollars to sweep those retail stops, absorb the liquidity, and aggressively reverse the price, they have established a massive financial position. They are mathematically highly unlikely to allow the price to fall back below that extreme sweep low, because doing so would put their own massive block positions deeply into a loss. You are effectively putting your safety net behind the institutional firewall, using their multi-billion-dollar capital as a bulletproof shield for your own position. Never trade a candle while the timer is still ticking. You must wait for the absolute verdict of the candle body close. Trade exclusively during high-volume kill zones, like the London and New York session openings, when institutional capital is at its absolute maximum. The chart is a flawless, unforgiving mirror of your psychological discipline. If you lack the patience to wait for the trap to spring, you will always find your stop-loss becoming the bait. Learn to read the hidden story of liquidity, wait for the footprints, and trade alongside the smart money. Stay disciplined, stay patient, and trade safe.